I'm Alan Kenny, Managing Director with REIT.com, and I'm in New York City for REITWeek 2012, NAREIT's Investor Forum. Joining me is Michael Commaroto, CEO of Apollo Residential Mortgage. Michael, the residential mortgage sector has been one of the top performing sectors in the REIT industry in the first half of this year. What's driving that growth?
I think there's two basic things, Alan, that drive it. I think it's really driven by book value growth as well as dividend yield. And both of those are really driven by the fundamentals of the industry. And the fundamentals that are driving it are really asset selection, both in the agency side of the business and the non-agency side of the business.
And Michael, how would you say that the business has changed since the start of the housing crisis and the economic recession?
I think the business has changed a lot. If you think about what happened in the housing crisis and the destruction of value, both in housing and in financial assets, has created a lot of opportunities in the space. On the agency side, you see a lot of stability of prepayments coming out of what happened with housing and a lot of these government programs, because people's personal balance sheets had gotten so banged up or so hammered as part of the recession. People's property values had gotten so depressed as far as values go that it became harder for people to refinance. And then beyond that, the banks have become much more risk averse. So they've also tightened their window or their box in terms of which assets can go through. So because of that, the prepayments that used to were a big bane of the existence of mortgage REITs are a lot more predictable in this environment. So you have much more predictability or stability around prepayments based on the factors we just spoke about. And that coupled with a steep yield curve. Now the curve's a lot flatter than it had been historically, but nonetheless, even at 130, 140 basis points, 2s to 10s, there's still steepness to the yield curve, and coupled with cheaper financing from the Wall Street firms in the form of repo, have created a lot of value in the agency space. And then in the non-agency space, there's value to be found by sifting through the wreckage of this housing crash. So there's still about $1.2 trillion of non-agency securities that exist in that market, and that people like ourselves have built models to sift through that wreckage and to try and find value in that space.
Looking forward at the second half of 2012 into 2013, what do you see being the primary drivers of performance and growth for your company?
I think right now we're very happy to be a hybrid REIT. We have the ability to be in both sides of the market that I just described, where you're both in agencies and non-agencies. So right now we're probably a little bit overweight agencies, given the fact that we just raised $250 million of fresh capital in the month of April. And out of that, we've probably invested on a levered basis about $1.4 billion of agencies and about $100 million of non-agencies. So what we're looking to do at this point is rotate out of some of the agencies that we bought and invest in more non-agencies. So basically growing our credit footprint, because we like the credit story. We think housing is much closer to a bottom than it has been historically. We think there's good value in that market, and we think it's one of the markets left that has real yield in it. Over time, we want to grow that footprint into other products, probably go into some whole loan arbitrage transactions, or possibly even MSRs. We've seen some of our competitors, other people in the peer group, doing MSRs. It's an incredibly attractive space as well. I think the goal of the business and REITs in general is to try and return stable book value and dividend yields that would be between low to mid-teens. And we think we have the ability to do that as we're doing right now and continue to do it down the road.
All right, well, thank you very much for your time, Michael.
Super, thank you, Alan. Pleasure.
And for more on this and other REIT news and analysis, check out REIT.com.